Hello, my name is Lindsay Shuck. Thank you for joining today's Family Office Network's webinar series featuring Bel Canto. I would like to introduce the chairman of Bel Canto Asset Growth Fund, Thomas A. Leonard, and the firm's CEO and founding partner, Jennifer Nevitt. Mr. Leonard is the chairman and founding partner of both Bel Canto Asset Growth Fund and 42 Apartment Property Management. Tom's real estate career began over 44 years ago when he started investing in multifamily assets in Philadelphia. Ms. Nevitt is founding partner and CEO of both Bel Canto and 42 and brings over 40 years of experience in multifamily real estate. Jennifer was the inventor of YieldStar, the apartment pricing software used by the nation's top apartment operators. She is recognized as a leading apartment industry expert. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you have so we can answer them accordingly.
Well, thank you, Lindsay, for that excellent introduction. And welcome, ladies and gentlemen. We deeply appreciate you taking time from your busy schedule to spend some time with us today. In my career, in looking at investments, I've always looked at the people who are behind the investments. I invest in people, not necessarily projects. Because we think getting to know us is important to any investment, I'm going to spend a little time talking about my background, so you'll get to know me and my background as a person, as a lawyer, as an entrepreneur, and a real estate investor. I'm the oldest boy in a family of 12 children. I was born and reared in Philadelphia, attended all schools there, including college and law school. When I graduated from law school, I joined the United States Army. And in the Army, I worked my way up to become a captain in the United States Army Infantry. Upon my discharge from the Army, I began to practice law as a corporate litigator in Philadelphia. I was effective as a trial lawyer, and as a result, in 4 years, I was named a partner in a national law firm. That 4-year timeline to become a partner was the record then and is still the record now. In addition to becoming a good lawyer, I worked hard at a variety of other endeavors. I began to invest early in my career in multifamily real estate. There was another young fellow, Ron Kaplan was his name, who was beginning in multifamily real estate. And together we started to acquire apartment houses. We believed that service to our tenants was the key to our success. And as a result, I always traveled with a plunger and a tool belt in my car. If Ron wasn't available to deal with the problem, I would come into a person's apartment clad in a 3-piece suit with the plunger and tool belt on, solve the problem, and we would move on. So I've been at the multifamily business for a long time. During this period of time as a young lawyer, I also got active in a variety of civic and philanthropic organizations. As a result of the recognition I garnered, I was proposed to run for city controller of Philadelphia. I was a candidate, I was a victorious candidate, and I ran again for a second term and won a second term. Interestingly, my work as controller made me chairman of the Philadelphia Public Pension Funds. That was a $4.5 billion fund that invested in a variety of areas. I determined as I sat as chairman that there were real opportunities to benefit the city, its tax base, and the pension fund if we used it creatively. I moved back to the private sector, and about the time I was moving back, my dad contracted cancer and died as a young man. After a period of mourning, we invited my mother to move in with us because we lived 2 doors from the church I had been baptized in and the church she had been baptized in. And we thought it would be convenient for her because she was a devout Catholic. She moved in with us, attended Mass and Communion every day, and lived with us until she died at 95. During this period of time, I continued to develop as a lawyer, and I developed in other arenas as well. I continued my multifamily practice with Ron Kaplan, and I decided to combine my real estate expertise and the knowledge I had garnered at the pension fund, and I approached the Philadelphia Business and Construction Trades Council and proposed that they make available to me a $100 million evergreen fund that I would invest in real estate to create union jobs and to get a good competitive rate of return on their investments. They agreed, and I, for the next 20 years, ran an SEC-approved real estate development firm that invested in all forms of real estate. I invested over $2 billion, created thousands of jobs, and got a competitive rate of return. I was regularly audited by the Department of Labor and got kudos for the management of the firm. During this time, I also began to invest in other real estate opportunities. I bought a chemical company, I bought a plastics company, I bought a facilities management company. I invested in finance, the development of the largest minority firm in the Commonwealth of Pennsylvania. And I did it based on what I said earlier. I invested in people. I'll give you an example. When I decided that I wanted to do this, these investments, I went to a fellow that I had gone to Drexel with, Bel Canto. He graduated #1 in chemical engineering from the school. He was then the executive vice president of Arco Chemical, in charge of all international operations. I said, Bill, I'm interested in investing in the chemical field. And if you see an investment opportunity where you would be willing to leave the job you have, sign for the paper, and become CEO, I'll provide the financing. He said, that's an interesting opportunity. And 4 or 5 months later, he came to me and said, I'd like to acquire Crowley Chemical. It's based in Manhattan, plants around the country. I said, fine. I provided the paper. I made him sign on the paper so that he had skin in the game and gave him a good chunk of the action. And we were off to the races. So my investment wasn't because I was an expert in petroleum products and chemistry. It was because I was betting on somebody who I knew to be an outstanding intellect with a tremendous work ethic. That's the way I've done these investments. During the same period of time, I also was active in a variety of civic engagements. I became president of the Board of Trustees at Roman Catholic High School. I served as the trustee of Drexel University School of Medicine and subsequently became a trustee of Drexel University, the parent university. During this time, I was also appointed to the board of Fannie Mae, the Federal National Mortgage Association, where I served for almost 6 years. I think the appointment was in recognition of my experience in the multifamily sector and the credibility I had garnered as an investor who took care of his partners and got a healthy return. I continued to grow as a lawyer and became chairman of the litigation department of my firm. Several years later, I was elected chairman of the firm, and I still occupy both positions, chairman of the firm and chairman of the litigation department. The firm is Overmayer, Redmond, Maxwell, and Hipple. It was founded in 1904. It's a full-service law firm with offices up and down the East Coast with a national footprint. During this time, I also began to wonder about how I was going to handle my wealth and how I was going to pass on the management of the various assets I had accumulated. I decided that I would like to transfer out of the corporations I had acquired and move my assets into a multifamily program that I was comfortable with, that I thought was a good way to preserve my assets and the wealth for benefit of my children and grandchildren. As I was starting to develop the plans to do that, I realized that to do it effectively, I needed a facilities management company, an asset management company with a national projection that could handle acquisitions all over the United States. I knew that to build that out and to get the best talent, I would have to invest money, but I thought that was the only way to really ensure that the multifamily assets that I intended to acquire would be well managed. Hiring third-party management doesn't work. You need the best, and they have to be working for you. I learned that during my years with Ron Kaplan in Philadelphia Management. About the same time, I was experiencing a difficult investment with my union pension dollars. We had a multifamily project that was not performing. The cash flow was not sufficient to meet the mortgage. And my manager came to me and said, "You're not a guarantor here. Why don't we let this go back to the bank?" I said, "Absolutely not. I've never let an asset go back to the bank, and I'm not about to start." I called the executive vice president of the Bank of America who oversaw our account. I told him the problem, and I asked him, who's the best person in the country to deal with the multifamily problem and to see if there's a way to correct it. He said, the best in the business is a woman named Jennifer Nevitt. She's hard to get and she's very expensive. And I said, well, you're the Bank of America. If you can get her, I'll pay her. They got her. I paid her. She was very expensive, but she was also the best at what she did. She came in, she studied the asset, she walked the asset, she studied the asset, she looked at our rent rolls, she really picked it apart. And then she wrote a report, and in that report, she outlined the steps that had to be taken to make this product work. We implemented her recommendations, and within months, it was cash flowing. Since that report, and since we implemented it, we've paid off the Bank of America in full, and we still own the asset. I knew then that I wanted to recruit this talented young lady to build out my multifamily program for the Leonard Family Trust. I asked Jennifer to lunch. I proposed that she form a new corporation and build it out nationally so that we could begin acquiring multifamily assets. I told her I foresaw a national footprint, and I told her that I wanted to build this out over the course of 10 years from about 1918 to 1928 into an $8 billion asset corporation. She said no, which surprised me, but I'm a persistent fellow and I kept after her. And eventually, after she made me make a significant number of concessions and commitments, she agreed to do it. I can tell you she's a very good negotiator. We then began the development of 42, and she hired the best people from around the country. She built it into a sizable organization, and we then started Bel Canto Asset Growth Fund, which was the acquisition vehicle for multifamily properties for the Leonard Family Trust. We are in the process now of building it out. In 2018, our first year in operation, we acquired $103.5 million worth of assets. In 2019, $242 million worth of assets. And already in 2020, we've identified 8 multifamily sites that are ground up construction, which will commence in 2021. We're off to a great start, and in large part, we're up to that great start. And great opportunities exist because of my partner, Jennifer Nevitt. Jen, you're up.
Thank you, Tom. I appreciate it. Everyone, thank you so much for joining us today. When I met with Tom initially for lunch, and he explained his chemicals and plastics, air cargo and facilities, I said, I do not know anything about any of those industries or disciplines, but I'm happy to transfer that wealth into multifamily And I'm competent in that I've already taken 3 firms and transitioned that wealth from a legacy perspective. And as I visited with Tom, again, a chairman of a law firm and a litigator, I was a bit skeptical that we could actually come to an agreement in certain varieties. And I'll be very honest. I really believe that people come first. I believe the front line equals the bottom line. And I think you have to care and nurture your people, and they will create tremendous wealth and returns. And as I visited with Tom and shared with him all of my core values and what I thought we should build as a company, he absolutely was in alignment. And I could tell that we actually had a terrific vision together. So the vision began with 42 LLC. And a lot of people say, well, why did you name the property management company 42? And at the time, I love Jackie Robinson, just so you know. It's my favorite number, and it was Tom's age. So I decided that we should actually think about that number. But that being said, I really needed to understand if he was going to let me lead through the vision of my 40 years in this multifamily space. And certainly he was willing to do that. We do not do third-party management for any firm outside of an inner circle. So my pitch to Tom was, look, I have 18 terrific clients. I love those clients. We had Toll Brothers, Amley Residential Trust, Princeton Properties out of Boston, JPI out of Dallas. And I said, a lot of them have their own property management firms, but I have a select few of an inner circle, and those individuals, 3 of the 6 come from billionaire family offices. I said, they'd be great first clients for this property management company. So currently today, 42 does manage for the Leonard Family Trust, in addition to the 6 clients in this inner circle that we've known for decades within my career. So just real quickly, let me share a little bit about my background. I've done only apartments for 40 years, and I love the apartment business. I have spent every hour of my waking moment considering how to produce a yield and return that was exceptional. As to Tom's point, we really believe in excellence, and we share a strong work ethic that you really have to do things well. I am fortunate to be the inventor of YieldStar. Some of you may actually be utilizing YieldStar today. We at 42 utilize not only that mindset and those protocols that I identified back in 1991 when I was with the Gene Glick Company in Indianapolis, but we continue to refine our entire business model on the amount of experience I've had. When I met Tom, the asset that he mentioned was in the capital markets crisis of 2008. So if you'll keep in mind that Tom and I have lived through 7 to 9 real estate cycles, we're really experienced at the difficult times as well as wonderful opportunities. And we knew to really create wealth and have a very, very, very conservative risk profile, we had to take both of our strengths and put them together to create a fantastic company. In the apartment space, I have trained over 20,000 multifamily providers. I am fortunate to have trained RAM Partners. I'm at ULI doing a faculty on what are the best practices of multifamily construction, which I love. And also I speak at the National Apartment Association. I'm an author of 2 books on how to excel at leasing apartments and how to really make your returns count. That level of experience, we then created 42. So just a little bit of background is our culture. Is the first formation of 42 was to prepare for the onslaught of that Leonard Family Trust and that money coming towards us, and to really prepare. We believe that the very first part of any great property management company is fiduciary. So real quickly, I'm often asked, even when I speak at national conventions, well, what makes 42 so special? You're just a property management company. There's so many. The key difference I will share with each of you is if you ask your apartment property management firm, do you have a course currently in fiduciary responsibility? Is that course available within the first 14 days of hire of every one of your brand new team members, from a housekeeper all the way up to an operator? And do they understand what their fiduciary responsibility is? And in my career as a consultant, I learned that maybe only 3% of apartment property management companies trained within a 14-day period, in addition to having that course available in several languages and a bilingual. We want to make certain that the front line equals the bottom line, and we train them as such. Of course, 42 is built on revenue management because I absolutely love pricing. We change pricing 2 and 3 times a day if we need to, all within the fair housing laws that we are regulated by in this country. We are exceptional expense managers. And we have a unique recipe that we have pace setters. These are very talented individuals that have been in the apartment space for over 20 years. The majority of them have my level of experience, my level of commitment to a fiduciary. They travel from site to site and enthusiastically audit and verify that that frontline team is executing on their fiduciary responsibility. And of course, we have the traditional customized report. We have a 5-point proprietary strategy at 42. And keep in mind that the front line does equal the bottom line. I've learned that over 40 years. We use Talent Plus. It's utilized by the Ritz-Carlton program, and we profile our candidates to verify that they actually align to Tom and I's core values so that we know they will represent us at the highest estate of what we find to be very important in our roles. We have a model that prioritizes our best practices, and we do management by exception. So every day we continue to refine, we have agility, we make certain that the teams in real time are coached on how they can produce even stronger financial results. And keep in mind, because I'm a financial person and I love pricing metrics and algorithms, we compare performance metrics. We have a very, very unique perspective that I want to share with all of you. We can set ourselves apart at 42 because we focus on the brand of that apartment community, not the corporate brand of 42, not that we're a property management company, but that real estate asset, its exact location, its address, and its name is the only brand that we invest in positioning, and thus we can drive our revenue and demand ratios much higher than a traditional management company that really absolutely just focuses on their brand and not the brand of that $50 million investment. And then finally, we always quantify performance. We want baseline progress, and then we align our team's compensation to the objectives of those investors. We're often asked, it's COVID, it's been a tough year in 2020. How's 42 done in their performance of the assets they manage to date? And it is with such sincere and genuine pride that I can state that we have a 95% current physical occupancy, that we have a 7% average annual rental increase on our renewals, and we have a 95% collection on our billables. So we really absolutely put the results of our performance and actions to the task, and those are then measured on those financial statements. Real quickly, I want to share a couple of our case studies of what we've done at 42 to represent the Bel Canto assets of Leonard, in addition to our inner circle clients. One of our very first Leonard investments was a value add. It's an acquisition in the state of Georgia. Many of you might actually do business in Atlanta, and you're looking at the first bullet thinking, the cap rate in Atlanta, Jennifer, is not 7%. And that just goes to show, Tom and I believe that if we're going to report to an investor our performance, we are very conservative. And so any of you can do the exact cap in Atlanta, Georgia, and you can see our tremendous value increase. But when we're reporting and we're training those property frontline teams, we're extremely conservative so that we don't ever have puffery or we don't overstate the performance that we can deliver. Again, Atlanta, great market. It has been a tremendous success story and a value add win for us. The second case study I'd like to share with you is new construction lease-ups. So if you were to put Jen Nevitt in a room and say, do something that you love, I would actually do new construction and development every day of my life, in addition to writing pricing models. So in the example that you can see currently on your screen, can you imagine that? Thank goodness we had the tremendous opportunity to have exceptional general contractor. In an 80% 6-month period, we received an 80% occupancy. We increased our rental income by 21%. So the moment that we get the keys on a real estate asset and that club room is ours, we immediately play a pricing game and a rental scorecard for our teams. And then they're rewarded financially, not only for just raising the rents, but the possession date is everything. If you want to work with an investment group that understands that you've got to move them in at the highest rent possible as quickly as possible, you want to invest with Tom Leonard, Bel Canto, and the 42 team and Jen Nevitt. So a lot of times people will say, well, that's great that you do ground up construction. We saw those results. You know, what's some secret sauce in the recipe of how Bel Canto actually looks at how we develop and design our apartment properties? So I've taken one of our protocols, what we refer to as a secret sauce, and we know that functional obsolescence will absolutely destroy yield on any new construction lease up. So we verify that to these top 12 components of functional design, that every floor plan we design that we build will meet this criteria, thus increasing our leasing velocity and our ability to increase rents because of the consumer traction and its significant impact on that rental income.
Now, Jennifer has just talked about 42, and you can feel why 42 gets the great results it does, and why she's been so successful in making these investments really cash flow. Bel Canto, which is our acquisition vehicle, has two business models in the one entity. The first is ground up construction, and the second is value add investment. The ground up construction, the target returns are 10 to 12% for the LP, that's the internal rate of return, and 6.5 to 7% yield on cost. In the value add investments, it's 6 to 8% to the LP internal rate of return and 8% cash on cash. The ground up construction, the target equity raise is 15 to 50 million. The equity split is 90-10, and the minimum investment is $2 million. Similarly, in the value add investment, the total is 15 to 50 million. The equity split is again 90-10, and the minimum investment remains $2 million. The ground up construction is concentrated in southeastern United States. The markets there tend to be 12 months a year. The land is still relatively cheap. The jobs are plentiful, and it's just a great area for ground up construction. Our value add investments have a national footprint. It's generally off market because of contacts that we have that come to us that want us to maximize the value of the asset. Sometimes they want to stay in for a small piece of the ride. Ground up construction, our leverage is 65 to 70%, and value add investments at 75 to 80%. The hold period for our investments is generally long-term in both ground up and value add. We underwrite both investments for 5 years so that we can get a look at how they're doing, but we frequently go into areas where we think the potential is much longer and much greater if we hold them longer term. If our investors want out, we work with our partners, we try to accommodate their needs, and we'll figure out a way to make that happen. The ground up construction acquisition type targets, 240 to 280 units. The capitalization is 40 million to 120 million. We look for suburban land and garden or 4-story construction. In the value add, it's once again 240 to 280 units. The capitalization is lower at 20 million to 60 million, and we only do Class A and B multifamily portfolios. The investment overview and the limited partner terms and conditions are worth spending a little time with. Our sponsor is Bel Canto Asset Growth Fund, LLC. It's a high caliber sponsor with over 80 years experience in multifamily real estate and during 7 real estate cycles, 30 years relationships with best-in-class providers. The property manager is 42 LLC, and the legal structure is a 90-10 joint venture, a special purpose entity, and single assets LLC. It's worth spending a moment on the special purpose entity single asset concept. You are investing in an asset that we underwrite, that we manage, that we project returns on, and that we invest in. You're not investing in a group of assets where somebody's hoping that they hit for 5 and 3 don't hit, but the 5 make up for it. Each and every one of our assets has a projection, has cash flow, and you're investing in a single purpose entity that you can look at and evaluate as a potential investment. The debt that we look for is 65 to 75% loan to cost construction, 75 to 80% permanent finance with the agencies, and maximum interest only before cash out. And as I noted earlier in the presentation, the agencies Freddie Mac and Fannie Mae are very familiar with me since I served on the board of directors of Fannie Mae for a number of years. The hold period for our business, as we've mentioned, is long-term. We look in the Leonard Family Trust for assets that can withstand the test of time, but we are willing to look for opportunities to take out partners whose financial requirements dictate that they get out, and we like to be a good partner. There is a promote interest earned by the general partner above the return, the preferred return. The state law that governs these limited partners is Delaware. It's a good corporate law venue. There's very little politics, and most of the American corporations are incorporated in Delaware for that reason. Our reporting is vigorous. We will report on the performance of the company on a quarterly basis, and on an annual basis provide annual audits and tax documentation. This is a little section on the fees. The development fee is 4% of the land, hard and soft cost. The property management fee payable to 42 is 4%. The operations fees, 1% asset management fee payable to Bel Canto. And we then move to some of the areas that we have ground up development opportunities. And we have others, but we're going to present the ones that are most imminent to develop. North Carolina, Tennessee, Pennsylvania, Indiana, South Carolina, Florida, and Georgia all meet the criteria on the right and all have the checks that you see in the blocks. The deal flow summary is a level of detail that I think I should send this back to Jennifer Nevitt so I don't embarrass myself.
Thank you, Tom. I appreciate it. Currently, right now, we have approximately 15 deals in the projection pipeline. What we're going to do today with limited time, but again, so that you have a great introduction of Bel Canto and who Tom and I are, is we currently have a deal flow of specifically 5 transactions, 2 in Nashville. I'm going to go through those with you very, very quickly. Please do know that you will be able to request any presentation on these deals. And first and foremost, I'm going to start with ground up construction. The deal flow that I'm mentioning right now is all funding in the next 21 to 30 days. They're the immediates. We try to fund approximately LP equity of $100 million every 6 weeks. So please know that our deal flow is consistent and will be coming forthright. For those of you who need an opportunity zone investment, we have a fantastic opportunity in Ocala, Florida. In Ocala, Florida, a half-mile due west of this piece of land, we have a distribution haven. The amount of $120 million infrastructure has been invested in this region just for the addition of Amazon, Chewy, FedEx, and AutoZone. We've all lived through the last 6 months, and we understand that the distribution channel is actually where jobs are being added right now. So when Tom and I look at a piece of land, and you're looking at the investment committee, Tom and Jennifer, we first and foremost verify that the job growth is there, even in difficult pandemic times. We want an asset, as he mentioned, that will withstand the test of time. We love 3-story garden walk-up. Fugelberg Koch is our architectural firm, and G4 out of Jacksonville. We use only the best providers, and all those providers have actually been on my team at least 20 of my 40 years. The second opportunity right now is in Charlotte, North Carolina. This is a great niche market. In Charlotte, we actually believe 50% of the demand is going to come from the state of South Carolina. This is a niche right off I-77, great piece of land. And this transaction we're actually doing with our joint venture partner, Nail & Associates out of Knoxville, Tennessee. From those of you from the great state of Tennessee, the Field & Family is very well known. They've been in the construction business for over 40 years. In this opportunity, we will fund in the next 14 days, and this is going to be one of our first joint ventures. We're excited about it, and in this case, the Field & Family, their entire general contracting firm, will act as our GC. Again, great elevation. The second deal is actually a combination. It's in Nashville, Tennessee, one of our favorite markets in the United States. And we've actually been looking for acquisitions, value add, or land there for over 4 years. We now have secured 2 sites. It's ground up construction. It will be 3-story garden walk-up with surface parking. And again, Nail and Associates will be our joint venture partner out of Knoxville, Tennessee. Any of these deal packets, please just send an email, any additional information or questions to capital@belcantoassetgrowthfund.com, and we're happy to give you very specific overviews and exact return profiles. Again, elevation, we're consistent, 3-story garden walk-up, tuck under garages. Our last opportunity is actually one of Tom and I's favorite. It is an off-market transaction. It was built in 2017, but it needs a light value add. It is in the greater Savannah, Georgia MSA. This asset is wonderful because it's an existing asset, so there's not the risk of ground up construction, but there's no debt on this asset. It's debt free. So we'll have the opportunity to secure some phenomenal terms on debt with today's rates. I do want to note that last year we secured the lowest interest rate from the Berkadia office of Philadelphia on our value add transactions in the state of North Carolina. And we take it very, very much in stride that we're not only trying to look at every dollar from the return in operations, but even how much can we take the return on the debt negotiation and verify that we have the lowest rate possible. This is a great opportunity to do that in the Savannah MSA. This asset is beautiful. It's stunning. You will see it's got a beautiful lake. It's really cute, 2-story cottage product, beautiful walkway. And again, the density is very low. 100% of all the residents have a private entry in this product line. 42 is the current property management firm. And again, through those relationships, we were able to create a joint venture offline. Here's an interior finish. I've mentioned to you, this is a light value add. You can tell that those kitchens are Formica countertops. We know that we've got to go to a hard surface countertop, in addition to some kitchen refinements, again, to drive the revenue stream. Tom and I have mentioned to you that we believe in really great people. He shared the example of the chemical company, which was one of the favorite examples I learned at lunch the first day I met Tom Leonard, is that he really believes in people. And I said, well, Tom, when I decide to come forward, I have team members and associates and peers that I've worked with for over 20 years in the apartment business. And I've already got a built-in staff that I'll be bringing with me. So on the Bel Canto Asset Growth Fund sign, these individuals that you see on the screen have all been in my life for more than at least 10 years, except Colin Koshlin, our great, fantastic asset manager, is new to the Bel Canto, again, but exceptional hard work ethic, as all of us do. We're very consistent in 12 and 14-hour days to create the strongest return for our investors. 42, these are our founding partners along with Tom and I. Again, individuals I've known on this screen, I've known for more than 3 decades. Great relationships, great individuals, and only the best and highest talent that I know of in the United States are on our teams. With that being said, again, I know we're going to open it up for questions here in just a moment. Tom and I really want to thank you for the opportunity just to meet and greet with you. We know that in today's world, we've actually been able to meet all of our partners personally up until this point in time. So utilizing this technology to meet and greet, we do welcome you to Philadelphia. We do promise you, we have 24-foot conference room tables and social distancing. Should you decide to come to Philadelphia and meet with us, is all available. We're very much committed to the personal relationship of our partners, our lenders, our team members, our employees, all of our consultants. And we really do make a difference in our business model. And more importantly than everything that we're providing relative to management of wealth of others, is that we really believe that people do come first. Any questions you have specifically on those funding, the examples I've given you are actually all funding opportunities in the next 14 to 17, 21 days at the most. Again, we have other opportunities coming up very, very quickly as well. And that email address is capital@belcantoassetgrowthfund.com. Tom and I very much appreciate your time. And that being said, Lindsay, I'm going to turn it over to you so that you can open up the questions, please.
Tom and Jennifer, thank you so much. Again, we encourage questions so we can have the open dialogue as we are live, using your questions chat option on your screen to send those over. To get started, Brad is asking, are any of your multifamily investment targeting federal opportunity zones? If so, what returns are you projecting for potential investors?
So Brad, thank you for that question. The first deal that I overviewed is in Ocala. That is an opportunity zone. The project IRR on Ocala is 22.9%. It is ground up construction and it's 3-story garden. That will close by fourth quarter of 2020. In addition to that, we actually have a new opportunity from another gain from one of Tom's other types of industry firms. So we have 2 other opportunity zone pieces of land that we're negotiating right now. So I'm not going to exactly tell you what state or zip code, but yes, we do opportunity zones often to protect our gains.
Thank you, Jennifer. Again, we'll just wait and see if any other questions come through, but if there's anything else that you guys would like to add, now would be the time. And I will, actually, I'm sorry, I'm going to interject here because we did have another question come through from Gunther. He says, I may have missed it. Can you share the past performance, say going back 5 years?
So going back 5 years, we have a high point of a 42% internal rate of return, and we usually always hit the 20% mark. We're somewhere between the 20 and 42. Hopefully January 1 will be providing even another statistic that's far superior to that as we're in the middle of another transaction.
Great, thank you, Jennifer.
And while we wait for any other questions, I want to reiterate the point that Jennifer made at the end of our presentation. We believe in being good partners, and we look for good partners. I'm very fortunate in my career to have a capital following because I've always made money for my partners and I've always treated them fairly. I like knowing them, and if you decide to invest, I'd love you to consider coming to Philadelphia so you can meet us and we can meet you, and we'll observe all the protocols, but I want you to get comfortable with who you're dealing with.
Thank you, Tom. Okay, let's see. We have another question. Let's see. Interested to discuss the Ocala deal. I'm sorry if I'm pronouncing that wrong. And what type?
Okay.
Yeah, thank you. And what type preferred you'd pay? Let them know that we can, you know, Brad would like to chat offline, but if you can kind of discuss a little bit further that deal, that would be great.
So that raises $13 million from an LP equity source. That email at Bel Canto Asset Growth Fund can actually send you the underwriting for it. The IRR is 22.9%, and it's a 6 to 8% preferred return that'll be negotiated.
That seems to be all the questions for now. Tom and Jennifer, thank you so very much for joining us today. To all of our attendees, on behalf of Family Office Networks, we thank you all for joining. Again, like I said, I will be following up with all of you individually. So if you have any other questions or comments, we can get you guys in touch with the team. Thank you so much, and we hope you have a great day.
Thank you, everybody. Bye.
Thanks,
Thank you.
Lindsay.